In very many cases, when we go to work, the reason we go to work is to earn. And to earn means to get money. When you ask students why they go to school, they'll tell you they go to school to get a job. And when they get a job, the reason is to get money. Among other reasons, some women, if not most of the women, the reason they have men because of money. And in fact, what defines a man, according to many women, not very many women, but many women, is money. So you cannot detach work from money in the heads and in the hearts of very many people. But we'd like to ask in today's discussion, what is money and how does money work? With me, I have Kabinuli Francis Lugolobi, who is a seasoned money teacher and money worker. I don't know whether I've used the correct terms. And that's the point where we'd like us to start. You have some money, some note, banknote in your pocket, in your wallet, maybe in your hand. What do you have? And that is the question that I'd like us to debate or to discuss tonight. When I have money, what do I have?
When you have money, you have a tool.
Okay? A tool like a hoe?
A tool like a hoe which helps you to dig.
With an axe. I have an axe.
You have an axe. But in this case, you have a tool which helps you exchange the value you have for the value you don't have but need or want.
Oh, I have
a tool which helps you to exchange the value you have for the value you don't have but need or want at that time.
Okay.
So money is just a tool.
So money is just a tool. Why do you call it a tool? Try to help us. Why do you call it a tool?
Money is a tool because...
Not a weapon, or it can also be a weapon. But let us stick to tool.
Weaponize, but
let's stick to a tool, yes.
It's a tool because...
How is it an axe? How is it a knife? How is it a hoe?
All tools come into play to answer a challenge. Okay. A hoe came into play to help us to cultivate land. Now, money came in as a tool to help us with exchanging value. In the beginning, when you had, for example, beans as your item of value, but you didn't want to eat beans. You wanted to eat beef.
Okay.
And you had beans, and I have beef.
Okay.
So what you would do, you would get beans which are equivalent to my cow, and then I give you the cow. And then you have to slaughter the cow and get the beef you could eat for maybe a month or 2 weeks or whatever. So that's how value was exchanged. But that value exchange had problems, whereby it wasn't necessary that when you had beans and I had a cow and you wanted to have beef, I automatically wanted your beans. So there was a problem which finance people call the double coincidence of wants, whereby I was willing to give you my cow in exchange for the beans at that right time.
Okay.
So many people didn't need what the others wanted at that point in time. And then of course other problems like moving the cow and moving the beans, transporting the items of value from place to place. So money came in as a tool so that when you had your beans, you could sell your beans and get money, that tool, that paper, and or coin. And then you give me the paper or the coin, and I give you my cow. Okay. Yeah. So money came in as a tool to help us avoid the problems and challenges of double coincidence of wants, of barter trade, basically.
Okay.
Yeah.
So here with me is a green 5,000 Uganda shilling note, and it's called money. So when I'm holding this note, please hold the note. When I'm holding that note, and when I'm working to get that note, what am I working for?
Actually, when you're working, you're not working to get money.
Okay.
You're not working to get a tool. You're working to get value.
Huh?
Yes. Anyone who goes to work doesn't go to get, just like when you go to a garden with the other tool, which is a hoe. You don't go to a garden to get
a hose. Yes.
No, you go to a garden to get food. So when you go to work to get value. And what's the value you need? You need to get food, you need to get clothing, you need to get accommodation, you need to get transport, you need to get entertainment. When you go to work, you are going to get that value. But then you are using this money is being used as a tool to access that value. Because remember, when you go to work, you're offering your value, your services. And those services are paid for.
So I'm exchanging value.
Yeah, you're exchanging value. So, because whoever you're working for does not have the food, the clothing, so what it does, it gives you the tool of exchange, which is equivalent to the value you're going to get. And that's where money comes into play. So, money is a tool which helps us to exchange the value we have.
So, money is a means.
A means.
Not the end.
The end. Money is a means of exchange.
Okay.
Of course, it has other elements attached to it.
Okay.
Yeah, because actually we're calling this money, but this is not ultimate money. This is currency.
Okay.
We'll talk about
another term, maybe.
Yeah, this is currency, and there are other items which are more of money than paper money.
Okay.
Yeah, because this money, all money has attributes.
Okay.
It has a tool. Of exchange, it has attributes. One, money of course has to be a means of exchange. You can be easily exchangeable. Okay. Yeah, from me to you for value as a tool. Okay. Then two, money should be able to represent value in people's minds. Whoever is using that money should be representing value. For example, if I look at money, it should be able to represent the value which I need.
Okay.
Food.
Okay.
So when I look at a 5,000 shilling note, it should be able to represent maybe a plate of katogo.
Okay.
Yeah.
So a money worker.
Yeah. Should be able to look at this
as a tool.
As a tool, and it's representing value.
Okay.
Even before you're using it, it should be able to represent a certain form of value in their heads.
Okay.
Then money should be also able to store value.
Okay.
Yeah.
That's what I want us to get after this short break. I would like us to talk about money as a store of value. Are you working for money or you're working for value? We're still talking about money, and when you talked about money, you introduced two terminologies that I'd like you to clarify. Money versus currency. Probably also if we could add legal tender. So if I have money, do I have currency? If I have currency, do I have money? What's the difference between currency and money, at least to begin with?
Yeah, thank you very much. Now, before you understand money and currency, we need to know what both of them can do.
Okay.
Yeah.
Both of them can
Both of them, what they both do. One, they both, money and currency, store value. They are supposed to store value. But one of them does it better than the other. So we'll get back to that later on. But then there are certain things which are very coherent with both. One, they measure value. For example, if I want to know
So they're a weighing scale.
a weighing scale
Of value.
if I want to know how much the value of a particular type of dish in a restaurant, I will ask for how much is it, and that how much will be, that's the value of the dish, to be told to me in form of money. If I want to know how much this shirt costs,
Yes, in fact, I bought this shirt when I was coming to this
Yeah.
shooting. I bought it at 25,000
25,000.
shillings. So what is 25,000? What is 25,000 shillings? Is it currency or it is money?
25,000 shillings is money. That's the value of the, because money represents
The
value.
weight,
Yeah, money, it comes in to measure that value.
Okay.
Now, when it comes to the storage which I started with, money is supposed to store value, and that value should be consistent over time. For example, if I keep 10 millions today, and that 10 millions can buy me a plot of land in Chiwenda, a plot of 50 by 100 land in Chiwenda. After 10 years, that 10 million, if it's money, should be able to buy me the same plot of land. Yeah. If you want to buy land and you keep 10 millions today, and then you wake up 10 years later and you want to buy the same plot of land, you should be able to buy that same plot of land using the money you've kept.
Okay.
If it is money anyway.
Okay.
So, but because the currency we are using nowadays is not money, it's currency. Currency does not keep value, does not store value. It loses value. That's the process we call inflation. Why? Because a plot of land which costs 10 millions today, 10 years from now, it will cost at least 20 millions, which means that it has lost, the money you have has lost 50% of its value.
Okay.
Whereas, so the currency you have, not the money, has lost 50% of its value. Whereas if it were money, it would have maintained the value.
The term currency, if it is an English word, stems from current.
Current.
So could you relate to that? How current is currency, and how can that relate to the understanding? How can it help my listener to understand this concept of currency?
Actually, the note you held, the note. Could you have any
I gave
currency
some,
notes here?
another new one.
Okay,
It's a newer note.
Now, this is a 5,000 shilling bank note
Okay.
with the words Bank of Uganda, legal tender, with the signature of the secretary to the Bank of Uganda and the deputy governor of Bank of Uganda. So this is currency. Why? In finance and accounting, we use that English term current.
Okay.
Now, the word current refers to current assets or things of value which must be used in the current time.
Okay.
Now, in the now.
Okay.
And those things the now in accounting and finance is between now in time and up to 12 months. So anything which you can use, which can keep value for up to 12 months without losing value, and after 12 months it's bound to lose value, and it's called a current asset.
Okay.
Yeah. So money is the most current of all current assets. That's why it's called currency. Because even for it can't even go up to 12 months. Money loses value usually in 3 to 6 months. It will have lost value, some form of value.
Okay.
Now, because money loses value in a very short period of time, for example, you can find a liter of fuel costing 5,000 shillings today. But in 6 months' time, it will cost 5,200 shillings. That means that the money, it's not the fuel which has lost value, no, or which has increased in value. No, it's the money which has lost value. So because money loses value at a faster rate, that's why it's called currency.
When money has lost value, what has it lost?
When money has lost value, what we mean is that this 5,000 shilling note cannot buy the same value it could buy 3 months ago or 4 months ago.
Okay.
Yeah, that's what we mean by losing value.
There
It means that the value is standard.
Okay.
The value is standard.
Therefore,
but the money, you need more money to buy the same standard of value.
Therefore, if I would like to immune myself from my value loss of money, what do I need to do?
You should not keep your value in money, in currency. You should keep your value in money and other forms of assets which do not lose value.
Say that again. I should not keep my value in money,
currency.
in currency.
You should keep your value in forms of money that don't lose value, and also
Such
in
as?
other fixed assets or long-term assets.
Give me the
which don't
forms.
lose.
Okay. Let us give me the forms that do not lose value. The forms
Now,
of money that do not
The
lose value.
forms of money which do not lose value are precious minerals like gold, silver, and other precious
Are you
minerals.
saying that silver and gold
Are money? Yes, they're money. And actually, there are many wealthy people who keep their value in money, which is gold.
Oh, now I get it.
Yeah.
So this is just a type of money.
It's a type of
This
money.
is type of
Currency is a type of money. Actually, to tell you this, when at the beginning, in the early days of money, currency was never used. The first forms of money were precious minerals, were precious, valuable items, which were actual things which had value. We had salt, we had gold, we had silver, we had cowrie shells, we had all forms of precious valuables. They are actual things of value, because this currency is not it does not have much value. For example, this is a 5,000 shilling note. But to make this 5,000 shilling note, the actual value within this 5,000 shilling note may be about 30 shillings. Because to make this 5,000 shilling note, you may need only 30 Ugandan shillings to make it. So the actual value of this currency note of 5,000 is about a maximum 50 shillings.
When we come back after this short break, I would like us to expand upon how best can we store value as related to money. Yeah? That we want, because he has given us forms of money, that silver and gold are forms of money. All right? Then he talked about something called assets. All right? When we return, I would like us to expand upon that point. Thank you. Keep it here. How best can we keep value? Most of us, after working, for example, some of us or some of the people here in Uganda in the year 2025, when they leave Uganda for going abroad and they do what they call kadama, the talk on their lips is get a plot of land, build a house. That's the best way you can keep value. Is it the best way of keeping value?
The best way to keep value is to keep it in a form which not only preserves the purchasing power of that value, but also gives you a return on investment, or it gives you more than the value itself over time. Yeah. Because sometimes when you store value, it can keep, when you store money or value, it can keep the purchasing power as it was. For example, if I keep 10 millions today and purchasing power doesn't change after 5 years, then it's a good store of value. But there are better stores of value whereby you get more than the 10 millions you kept. For example, if you keep 10 millions today, after 10 years or 5 years, it will be worth 12 million. So those forms of storage are the best forms of keeping value.
Okay.
Now, I'll start with the craze which is around nowadays, which is cryptocurrency.
Okay.
Yeah, cryptocurrency. Many people are going into the cryptocurrency craze Because cryptocurrency is another form of money. It doesn't lose value, it shouldn't lose value. But then there are many cryptocurrency scams of late.
Okay.
Whereby it's also easy to lose your money in a cryptocurrency scam. Whereby those who run the cryptocurrency machinery, they take off with your money, with your value, with your cryptocurrency. So apart from if there are no scams in cryptocurrency would be a good store of value. So if you are storing your value in cryptocurrency, be very cautious on what type of cryptocurrency you store it in. For example, one of the good cryptocurrencies is Bitcoin, but Bitcoin is very expensive to buy. One Bitcoin is over, I think, $100,000
Ah.
yeah, which is over 400 million Ugandan shillings. So it may be out of reach for an ordinary Ugandan. So, but when it comes to other forms of storage, many people go into buying land, into building rentals, and a few people going into treasury bills, treasury bonds, into shareholdings or stocks. People going into those. Now, the form of storage of value you need is determined by how much money you have and when you are going to need it back.
Okay.
Now, if you have little money, if you have a few millions hanging around, it's not good advice for you to keep that money in land, in rentals, or in long-term bonds, government bonds,
Okay.
or even in shares.
Okay.
If you have little money, that money is for you to maintain that value and to grow it. You should not even keep the money. You should not store that money.
Okay.
You should invest it in high-risk investments.
Oh,
High-risk investments are those.
must they be high risk?
High-risk investments are those investments which gives you a return on investment in a short period of time,
Okay.
and also they give you a high return on investment. So you should look for a venture which you are interested in and you are knowledgeable about, and you can invest your money there because you have little money, and the little money can be put in the other good stores of money. The other good stores of money are gold. You can buy gold because gold doesn't lose value.
Okay.
Now, if you have good money and still you want to store it well, you can open a fixed deposit account.
Okay.
In Uganda, most fixed deposit accounts give you a rate of an interest rate of 10% per annum,
Okay.
or more, or even up to 12% per annum.
Okay.
That means that even if Uganda's inflation may be 6% or 5%, if you invest in a fixed deposit account, you're going to earn the extra 5% after removing if, for example, you deposit 100 million on your fixed deposit account,
Okay.
at the end of the year, you're going to get a return of 5 million. They're going to give you 110 million.
Oh.
Yes.
Oh.
Yeah, that's 10% after 12 months. And then if the 5 million has been eaten away by inflation, by purchasing power loss, that means that you're going to have a profit of 5 million. Now, fixed deposit accounts can work like in the same way as treasury bills and bonds and shares, because they give you a return on your investment. Only that the fixed deposit account, the return is fixed, whereas for even treasury bills, the return is fixed. Even bonds, the return is fixed. But with shares, you earn depending on how much that company you've invested in has performed. So if you invest in a high performing company, you're going to get a higher return on investment, a higher percentage. So there is a risk even of losing, whereby if your company performs poorly in that year and makes a loss, you're not going to get a return on investment. But then there are even other storages of value which are better than, which gives you, not only give you a return on investment, but they also grow in value.
Okay.
Whereby, as I explained before, when you put your money on a fixed deposit account,
at a given percentage,
you only get at a given percentage, you only get an interest, which is 10%, for example.
Okay.
But the other 100 millions you fixed does not increase in value. It will still stay 1 million, 100 millions. Actually, it will lose value because after 5 years, the 100 millions won't have the same purchasing power. If, for example, you decide to withdraw your money from the bank account, after 5 years, the 100 million, you have gotten the interest over those 5 years, but the 100 millions will still be 100 millions and it won't buy what 100 millions bought 5 years back. So the 100, whatever the value fixed would have lost some value, though you'd have gotten interest over that period of time. But there are certain other investments which increase value over time while you are also benefiting from them.
Okay.
And actually the reason why they are called real estate. Real estate is called real estate because it's the form of storage of value which gains value over time and does not lose value. Whereas you're also getting the interest or the return on investment over that period of time. That investment itself, as of itself, it's gaining value. For example, if you build a house on a plot of land, in addition of you getting rent from that house, one example I can give you is I built a house in 2006 up to 2010. That house cost me 50 millions to build. Now, I've been getting rent from that house since 2010. My first rent was 500 shillings monthly.
500,000
shillings monthly. Now I'm getting rent of 1.2 million Ghana shillings every month.
From the same asset.
From the same asset. But that asset is giving me a return on investment, which is lower than, it's a low risk investment. So the return on investment takes, it took me 8 years to get back the money I had invested in that house. But that house gained value.
Okay.
Not only, I did only get the rent from the house, but I also gained value in that house because that house gained value. Now that house, the current valuation of that house and the land on which it's seated,
which you finished at 500,000 shillings.
No, which
in
in
2010.
50 millions.
Yeah,
50
yeah,
million.
500,
50
yeah,
million.
50 million. Yeah, 50 million in 2010.
And the value of the land was 20 millions that
then,
time.
in 2010.
So the total value of the asset was 70 millions
In 2010. Yeah. Now, 2025.
Currently, the value of the house plus
the land on
which
it
stands is 200 millions Ugandan shillings. So I have gained in two ways. I've gained rent over the period of time for the 15 years, but also my asset, if I decide to sell it now, I would have gotten a return on investment in the actual value, in the intrinsic value of the land. So the best assets to store your value in are those assets which can grow alongside giving you a return on investment.
That is it. We would like to ask, how best can I keep money without losing its value? Do you recommend a saving account? And if you do not, why? And if you do, how long should I keep my 10,000 shillings on a saving account? Because whenever you talk about keeping money, that's what happens, that's what comes to the mind of everyone. Open an account so that you save. If I'm a salary earner like me, when I earn a million shilling every month, it is highly recommended by you accountants and money teachers that I keep at least 10% of that for savings, like you call it. So, question: how can I immunize myself from having my money lose value?
Now, I'll start answering that question from the reason why people work.
Okay.
The reason why you and me and anyone out there works is to give out the value they have in form of their service in exchange for the value they don't have.
Okay.
And the value they don't have is the food, the clothing, the shelter, the means of transport, and all that. Now, many times when you work, you get more money than you need presently to cater for the value you need, to cater for your needs.
Okay.
That means that you'll have extra money or tools. We said money is a tool which towards the value. So you'll have more value left over at the end of 1 month than needed in that month.
Okay.
So what most people resort to is to store that value.
Okay.
Because you've eaten, you've clothed, you've had shelter, you've moved from place to place using the money you made, but then you still have more money left over at the end of the month. Now, because you have more money left over, you need to store it.
Okay.
So many accountants and finance people in the finance field encourage others to save money on a savings account in a piggy bank. And
in fact, that's what we do. Even our little children, we say, "Oh, this is her pig bank. This is his piggy bank," and so on, and then an account and so on. So,
but that's very false. That's a very false or wrong way of storing the value which you have in money.
Okay.
Because money is supposed to store value, and you're using your currency to store that value. As I told you that money at best can store, the Ugandan shilling can store value intact for
3 months.
For 3 to 6 months. In good times, can store the value up to 6 months.
Where here value means what it can purchase.
What is purchasing power?
Okay.
Money can hold, the Ugandan shilling can hold onto its purchasing power for
between 3
to 6
to
months.
6 months.
Yeah.
In other words, if 5,000 shillings can purchase a chicken drumstick, now we give it a period of 3 to 6 months.
Yeah.
After 6 months, it might not.
It might not. 10 million shillings can buy you a plot now, a plot of land now in Juenda, but in 6 months, you may need 11 million shillings. So it would have lost value. That's what I'm talking about. So the purchasing power of money, its value.
How many items it can purchase.
Yeah.
How many items of value it can purchase.
Since you've established that a Ugandan shilling note can keep its purchasing power for up to 6 months, that means that you can only save money for up to 6 months without losing its value. So I encourage people to use piggy banks and to use their savings accounts for no more than 6 months, because they risk losing the purchasing power of the currency which is stored there.
That is a note, I can't just miss that. If you are to keep this on your account, let it not exceed 6 months. If you kept it there in January the 1st, it should end June the 31st.
And now, I want to tell you, before I move on to the best keepers or stores of value, I want to tell you why people are encouraged by accountants and financiers and the wealthy to keep money, to store value in money for longer than 6 months, for 3 years, for 5 years, because people in finance advise everyone else, the working class, to keep money for long periods of time. Actually, I've had people advise others that if you want to buy a plot in 5 years from now, you need to keep money every month for 5 years to raise the money. If, for example, you want to buy a 60 million plot of land or a 60 million vehicle, you keep 1 million every month. You save 1 million every month for 60 months, which is 5 years, and then you buy that car, and then you build that house, and then you buy that plot of land. But these people, many of these people are telling you to do that, know the truth, and they themselves do not keep money for more than 6 months.
Oh.
Actually, they do it deliberately, because under capitalism, you need to raise capital to invest. These are capitalists. They need to raise capital to invest, which capital they don't have, or they have little. For example, someone may need 1 billion Uganda shillings to invest in a factory, and they have only 500 million Ugandan shillings. So what this person does, you have to encourage 500 Lugolovis or Peters to save 1 million every month. And when they save that 1 million, you go and borrow it and invest it. So these capitalists, they encourage you to save not for your good, but for their own good, because they're going to save that money in a bank, your bank saving account, and your bank is going to get the money out of the bank account and give it to the investor or to the proprietor, entrepreneur.
So would you advise that if I wanted to buy a Subaru Forester 2015 and it goes for 60 million Uganda shillings, and as I speak now, I have 30 million. Would you advise that I deposit this 30 million with the bond owners or with the car owner, so that meanwhile I drive while I'm waiting to make the 60 million? Should I give them the 30 million and meanwhile I drive? Would you advise that I do that, so that I start utilizing the value with the money I have as I pay bits and pieces?
Actually,
would it be financially prudent?
It's very financially prudent to follow the people who use value best. The people who use value best, and those are the wealthy people and the entrepreneurs and the capitalists, they do not keep value. They wouldn't keep the 30 millions in a bank account as they wait to get the extra 30 millions, or they save for the extra 30 millions.
Okay.
What they do, they look at their current cash flows, and if they establish that they can pay back a loan of 30 millions within maybe 1 year by paying 3 millions every month. For example, if you're earning maybe 7 million or 6 millions, and your lifestyle costs are 3 millions, so you have a leftover of 3 millions every month. That means that you can go to a bank, and the bank can loan you 30 millions, and you top up onto the other 30 millions, and you drive away with your car. Then every month you pay the bank 3 millions.
So that means if the car goes for 30 million, and currently I have 24 million, if I'm going to bargain, if I will bargain with the car owner, and I say I have 24 million, I will pay the 6 remaining million in the next 6 months. Am I speaking in a financially literate manner?
Very financially literate. Very financially literate. And not only for luxury or for lifestyle expenses, but even when you're investing, it makes sense for you to invest now than in 5 years' time. Because if you're looking for capital to put up a factory, and you start saving now for a particular factory, for example, you're going to make what gadget can you're going to publish
Books, yes.
Your teacher, you're going to publish books.
Yes.
Now imagine you're saving for books, and the capital you need is 100 millions, and you can only save up 100 millions in 3 years. Now, by the time you raise the 100 millions after 3 years, that book may be irrelevant, or a better book will have been published. So you have lost out on the value.
The more current the value, the better.
It's called the time value of money.
Time value.
Time value of money. Money is time sensitive because money loses value. The currency loses value over time. Over time. So, what you need, whatever you need or want, whatever value you need or want, you want it now. You don't want it in 3 years' time.
Whatever value you need it now, not in 10 years' time. When we come back. Welcome back, and this is In Truth and in Spirit Well of Worship Fellowship. My name is Peter Calviland Serubide. I'm still with Francis Lugorobi Kabinuli, a finance expert and advisor. My question, which I share with my audience, is I have 10 million shillings, but I do not need the 10 million shillings right now. I might need it after 4 or 3 or 5 years or thereabout. What do you advise that I should invest this money in so that I don't lose its value? Neither should I lose its purchasing power. But again, in the end, I want to profit from it. What is the best investment plan you can advise me about?
Now, the best investment plan for 10 million shillings, which you won't need in 5 years' time, is based on availability of the following products, investment products or investment vehicles. You can buy land. 10 millions can't build a rental property, but you can buy land. So long as you verify that that land is owned legally by whoever is selling it to you, and they can transfer the title deeds of that land to you on purchase of that land. You've done a good search.
So I must do some good due diligence. You don't just buy land.
Yeah.
Okay.
And
why land?
And you should because land is real estate. And as I explained earlier, that real estate is called real estate because it does not lose value. Actually, it gains value over time.
Okay.
Land gains value over time. So you can buy that land, but then you must also consider the location.
Okay.
Yeah. Certain locations have gain value faster than others. So if most locations in the suburbs of the capital city of Kampala gain value faster than other locations which have a more rural setup. So if the location you can get a plot in is in the suburbs of Kampala and it's showing signs of becoming a residential complex in the next 5 years, if for example it has a few, for example it's about maybe 10 or to 50 acres of land, and there is one plot of land there which is 50 by 100 feet, and then you are seeing maybe a few houses, residential houses, maybe about 20, but then the road works are being done, and then the roads are good, feeder roads are being constructed, and there is there may be a school or two which are being constructed there, and the water utilities, the water pipes are going through that stretch of land, that area, that location, and there's electricity available, and you're seeing signs of maybe there's a factory which has opened up there. So those are signs that that land is going to grow in value in the next 5 years. So you can buy that plot of land. Okay. Because in the next 5 years, worst case scenario, that plot of land is going to, you can sell it at over 20 millions.
Okay.
So that land would have gained value. Would have gained value to even if there's been some inflation, whereby some inflation at 5%, whereby the value, the 20 millions you get out would have lost maybe about 3 millions. Then the other 7 millions will be a good profit, a return for you. Then there is also shares. You can buy shares in a company. Shares, I have a disclaimer. Shares in Ugandan companies have been a bit tricky. I won't name names, but all of you know of companies which 5 years ago were high performers. People bought shares in those companies, very huge companies on the Ugandan stock exchange or capital markets, very huge companies. But then, right now as we're speaking, one of those big companies has spent 3 years without making a profit, making losses. That means that the value of the shares has gone down, and the return, the return on investment, which is a dividend, the shareholders haven't been receiving dividends for those years, including this year, because it has lost value. So when you're buying shares, you buy. I'll just name this company because it's no longer existent in Uganda. I'll give an example of Umeme. Umeme was a good bet if you're buying shares. Those who bought shares in Umeme, Umeme was a utility company whose product was needed by the country, and we are certain of its growth. So whoever bought shares in, so if you find a company like Umeme was, whereby of course Umeme lost its concession, and it's now the government of Uganda which is running the electricity supply, but it didn't go bust that like it was. No, it was performing well, just because of concession, but even the members didn't lose out. So if you find a company which sells the product which is needed by the market and which is bound to grow in value, please buy shares. I'm not advertising for any companies, but buy shares in such a company.
Okay.
Look at its track record. Look at how it's been performing. Look at its balance sheet, its income statement. Those financial reports for the past 5 or 10 years. Look at its return on investment. Look at its dividend share out to the shareholders every year, and then based on that, on the rate at which this company is performing in those areas, and its viability, its going concern, and its nature, whereby the product is selling are really needed by society, so it can't go bust. Okay. So then, based on that, you can buy shares in that company.
Okay.
Yeah. By the end of 5 years, if you bought shares of 10 millions, if you decide to sell off those shares may be worth about 20 millions maybe,
okay,
or 16 millions, or 15 millions. But on top of that, you would have been receiving dividends every year. Okay. Dividends are the profits which are shared out to the shareholders. Yes, you would have been receiving the dividends every year, and you would have gotten a payout when you're selling off those shares.
What about the bonds? Are they the same as shares?
No, bonds are shares which are given out by government.
Okay.
Yeah, when government wants to borrow money from the public, it issues out bonds, treasury bonds. Now, the bonds or treasury bonds, these are the long-term finance instruments, whereby when a bond, for example, you cannot cash in on your bond in less than a year.
What do you mean by cashing on your bond?
You cannot sell off. You cannot. Government cannot pay back your money.
Okay.
Your money in less than a year. Whereas with a treasury bill, you can get back all your. For example, if you put your 10 millions, and you use the 10 millions to buy treasury bonds.
Treasury
bonds. You can only get back your money. Now, they'll be very good because bonds will be very good in your scenario because you don't need the money in the next 5 years. Okay. So you can buy a 5-year treasury bond, and then the treasury bond, you get back that money. Government will give you back your 10 millions at the end of 5 years,
okay,
plus the interest. And that interest maybe if it's 15% every year. If 15% every year, imagine that's 15% times 5 years, which is 75%.
Okay.
And it's cumulative.
Yeah. So
yeah.
it's 75% of 10 million.
Yeah. Over yeah, because it's cumulative, it will be more than even 75%. Because even the annual profits are added back on the 10 millions. Well, the 15% of the first year is added back to the 10 millions. That is, so on the second year, you are earning 15% on 115 millions.
Okay.
So you may get back about 20 millions at the end of 5 years. So those are good vehicles to. But then if you had more money, there are even more interesting investments where you get more return. But with the 10 million, that's what I would advise.
Okay.
But with or even you can if you're risk averse, you can even put that money on the fixed deposit account. You can invest your money on the fixed deposit account, giving you maybe a prime rate of 12% per annum.
Okay.
And then you don't take out the whatever profit you earn at the end of every year, you reinvest it. You fix it over and above the 10 million.
10 million.
Yeah, and then it goes on multiplying. So at the end of year 2, you'll be getting 12% on 112 million.
Well, thank you.
On 1,120,000.
Well, thank you very much for keeping it here on in Truth and Spirit Well of Worship Fellowship. That has been what I shall call money literacy or money education. You will find such clips on our YouTube, but you also find this posted on our TikToks, most especially on Francis Karino Rugorobi TikTok account,
Account it work Financial Vibes, local TikTok.
All right.
It's called Financial Vibes, and it's we also have you can also check by Francis K. Lugolobi. There are many Francis Lugolobis, but you check for Francis K. Lugolobi.
So you'll find this on our YouTube, in Truth and in Spirit Well of Worship Fellowship, and on our various TikTok accounts. Thank you very much. God bless you.